Mr. Das, thank you so much. I would like to once again formally welcome you to this, and we'd love to have you share your expertise with our audience, of course, the live audience today, and the much larger audience that will eventually view this later. So, Shiloni will be your moderator for the session, and she'll take you through the entire structure, where we'll, of course, have your session to begin with, and then audience question and answers. Thank you. And Shaloni, over to you.
Thank you, Richa. I'll just do a short introduction to Mr. Mrunmay Das. Thank you so much, Mrunmay, for agreeing to, do this session for us today. It's my proud privilege to welcome you, Mr. Mrunmay Das, Director of Das Capital, to this session of Women and Wealth Summit 2025. Mrunmay comes with a degree in physics and management and brings with him over 30 years of understanding of financial markets. He has worked as a dealer, back office, derivative desk, research analysis, investment broker, and also a chief investment officer. He has worked with brands like Merrill Lynch, BNP Paribas, UTI, and drum rolls, please. He was the founder of the Azim Premji Family Office. He took care of Mr. Premji's money at a time when Mr. Premji was the richest Indian. This was way back late 90s, I think, or early 2000s. Today, he runs his firm, Das Capital, which helps HNIs and individuals with analysis, research, and complete investment takeover and plans. What is very, very interesting about Mrunmay is that along with running an investment firm, he is also a professional cricket player. He has played cricket at the national level for Odisha and Goa. He plays a cricket league, the MCL 11 League, as part of the Team Tigers. In fact, the reason we started our session at 4 as opposed to the standard 3 p.m. for us is because he had a match today. So without further ado, I will hand it over to Mrunmay. Again, welcome, Mrunmay, and really looking forward to this session.
Thank you very much for the introduction. Am I audible?
Yes.
Am I audible?
Yes.
Yeah. We can put the slide.
Yeah.
As you must have heard just now, that 30 years of experience, the key part of this experience is I have only dealt with personal finance. I have not done anything else in finance, which is a vast subject. And remember the part that I'm a physics graduate. So a physics graduate with 30 years of work experience only in personal finance. And when I decided after Mr. Premji's assignment to start on my own, day one, I started a private limited company. Because the whole idea was to have a team which will help me learn and grow from here, make this a legacy for lifetime. A private limited company is different than an proprietorship or an entrepreneurship where, it is Mrunmay Das on his laptop. It is not that. Today, I am proud to let you know that my team has an experience of close to 120 man years. I have 10 people. All these guys I have been associated during my teaching assignments for the last 20 years in various schools. The gentleman who runs the company today at the top is a junior of mine from the same B school where I have passed. He is 5-6 years junior to me. The other people who are in my team, all of them are MBAs. Couple of them are CFAs and others are pursuing CFA. The whole idea to bring this to your knowledge is that when I started this company, I wanted to make it a going concern, stay with the client for life and generations to come. So we can go to the first slide. These are the life stages of an investor. The key part in this slide to look at is the 3 boxes that is being made under 4 categories. The boxes are earnings, consumption, and savings. If you look at, as the life goes up, the potential to save goes up till you are 60. At 60, you are left with only consumption because unfortunately earning stops. And with earning, you don't have surplus to save or invest anymore. Therefore, you will consume till you leave. And today, with the expectancy, we are looking at 100 years for a couple to survive. And you have grandchildren to take care of and their future to secure. So, therefore, there is no two ways about not doing your investments on time and early. And throughout the time when you have your earnings, you should get into savings and investment. That is the whole idea of this slide. We can go to the next slide. As all of you must be aware or seen this at times, procrastination is always there in when you start anything different. Investment is in the same category. People find when I meet them, someone says, I want to finish some pending work, someone wants to wait for 5 years, someone wants to build up a savings first for a certain amount before starting a portfolio with us. I can give you some extreme situations also. These are all good situations. If you look at, the two person that I have given, their age is 30 and 40. But in real life, I have clients, someone who I met, we are starting to onboard him, I think 15 days back. This gentleman is my age. I am around 52. He must be 53, 54. Entire life earning is in fixed deposit. He has no other savings till date. So I'm not talking about a 30-year-old with interested to put 20,000 or a 40-year-old interested to put 20,000. Here, this gentleman that I'm referring to has his entire life earning in fixed deposit. And today he's trying to start his investment journey with us. And as we progress in this presentation, how I will define this fixed deposit as no investment at all. So you have to look at the right strategy to put money in the investment to remain relevant as far as financials are concerned. We can go to the next slide. This is the slide that I was referring to. If you look at what is saving and what is investment, bank balance and deposits are savings. They earn you anywhere between 6 to 7%. If you take the taxation in this country today, which is for bank savings and bank deposit at 30%, your net earning is less than 5%. And in the subsequent slide, I will show you where inflation stands in India. And I'll prove to you that by putting fixed deposit or keeping money in the bank, you are basically paying the bank 2 to 3% to keep your money safe. It does not grow. It is basically depleting over time. And vis-a-vis that, investment is something which grows, which is what, if you look at the bottom three, pictures, what it is showing, these are the assets which you buy where there is a chance of your capital to grow. We can go to the next slide. These are the two slides, this slide and the subsequent slide. I want to impress upon the point of inflation. This is quite self-explanatory how things have moved in India. And the inflation column, please pay attention to the last column. Look at the inflation that India has gone through in the last 10, 15, 20 years. So when I'm talking about a bank deposit, if that earns you anywhere between 5% to 5.5% post-tax, you look at the average inflation column on the right, you will know why I am saying you have to pay the bank 1% to keep your money, or your money 100 rupees today becomes 98 rupees next year if you keep it in the bank, because inflation is going to eat into your savings. We can go to the next slide. Similar thing what I have with you, 1 lakh rupees today is with inflation 2.65 lakhs in 20 years. And if you have 1 lakh in the bank today, in 20 years, it is worth 37,689 rupees, only because of inflation. So impact of inflation on expenses, in fact, impact on inflation on savings. Both are quite drastic and dramatic if you look at the numbers. The sooner we realize, we shift into what I want you guys to do all the time. We can go to the next slide. This is where we come into play. What I'm trying to tell you is, while you are gathering up your financial capital by working hard, if you do not pay attention to make the money that you are earning to work for you, that is, the money in investment will give you certain return over a period of time. If you are in the right place as far as your investment is concerned, that money can be as high as 12 to 15% per annum, even post tax. 12 to 15% per annum. I will give you a secret formula, the formula of 72. Please try to remember the number 72. If you want to double your money in 6 years, your return should be 72 divided by 6, 12%. Or vice versa. Someone comes and tells you that, Mrunmay, I want to give you 18% return and your money will double in 6 years. There is some mistake that he is making in the commitment. If he is giving me 18%, my money should double in 72 divided by 18. How many years? 4 years. So if you remember 72, your doubling formula is never going to be wrong in your life. And this is a lifesaver, because the moment you know in how many years your money will double, you will start saving. Because if I'm telling you the investment avenue where you can make 12 to 15% per annum post tax comfortably, we are talking about a 5 to 6 years of doubling every time. So 100 rupees today will become 400 rupees in 10 years. And more so, look at what it becomes in 20 years. 400 doubles to 800, 800 doubles to 1600. 100 rupees in 20 year becomes 1600, 16 times. So this is the power that you can use while you are doing your job, business, or entrepreneurship and earning money. If your financial capital is apportioned towards, from your earning towards financial capital, while your human capital reduces, your financial capital will take care of you for the remaining part of your life. Save your, will help you to take care of your next generation. Not even one, maybe two generations. And this happens with tax planning, because the investment vehicles that we suggest, taxes are almost next to zero. I will show it to you in the next slide. These are the return of various asset classes in the last 15 years. I am talking about equity mutual fund, 17.5%, gold 12%, real estate around 9%, and fixed income, meaning fixed deposit, around 7.5%. Now let us go at taxes for each one of them. Equity mutual fund is tax-free for the time that you don't take the money out. People say that equity mutual fund invites a tax of 10%. It is not totally correct. 10% is only when you want to redeem the money and use some part of the money. I have clients who have been investing with me for last 15, 20 years, and they have not redeemed at all. These are the people who are sitting with gains which are 80 to 90% of their entire portfolio today, and have not paid any taxes because we have not taken the money out of the market. For example, a person 20 years back had started with me at 5 lakhs. Today the portfolio is close to 1.5 crore, and he has not redeemed at all. Tomorrow he needs 10 lakhs. He will take the 10 lakh and he'll pay taxes only on that 10 lakh, which will be less than, in 10 lakhs, the taxes will be less than 30-40,000, 3 to 4%. Because he'll get the legacy effect. Tax equity was tax free till 2018. So only from 2018 to 2025, the earnings that he has made, he will pay a tax of 10%. So imagine a portfolio of 1.5 crore over a period of 20 years created by small savings and investments throughout, and you have not paid any taxes because you have not disturbed the money. Only, please remember, equity mutual fund is taxed at 10% only when you take the money out. And necessarily, people don't take money out every year. Sometimes they take out in 3 years, sometimes they take out in 5 years. Some people take out only 5 or 10% of the money. So, therefore, equity mutual fund, overall, if you look at, is almost tax free for the time that you make. And if you are growing at 17.5% over 15 years, now apply the formula of 72. You know what I'm talking about. You have doubled your money almost every 4 years for last 15 years. Now you have the calculation 100 rupees has become 1600 rupees in 15 years. 4 times it has doubled. This is the power of compounding that you can do in India. These numbers are from Indian market, Indian mutual fund, not the very best. This equity mutual fund, when I put the column, that includes every mutual fund in this country. The good ones, the bad ones are included, the average ones are included, and the best ones are also part of this 17.5%. So not necessarily choosing the right investment would have given you this return. What has helped you to get this return is to choose the right asset class. Equity mutual fund is called an asset class. Gold is an asset class. Real estate is an asset class. Now, another thing that I want to talk about gold, because we have been so involved in watching the gold grow. I have some data to share with you, very interesting data. Gold has grown by 67% in last 1 year, by 100% in last 2 years, and by 150% in last 3 years. If you look at gold from 2020 to 12 years back, gold return is single digit, 6-7% per annum. The figure that it is showing here, 12% gold in last 15 years, is because last 3 years gold has gone up by 150%. 100% means it has doubled in 2 years. 150% means it has become 1.5 times in 3 years. Why this has happened? Why this sudden spike in gold? If you remember, the world has gone through a severe crisis of war, which was never seen in the last 2 decades. Started with small skirmishes here and there. Ukraine war became big. We had a problem with Pakistan. America had a problem with neighboring countries. Israel had serious problem in Gaza. Because of all this, people flew to gold because gold as an asset class has no definition. It's a pure metal. There is nothing to evaluate or analyze as an research analyst like us about gold. It's a finite asset class which does not require a value finding. Value is defined already. So people go to gold more for safety than for investment. And hence, last 3 years, 150% return is justified, visible, and hence gold is standing next to equity at 12%. All my career of 27 years, before the last 3 years, I have seen gold as single digit throughout, and I have never allocated more than 5% to gold. This 12% it is showing proudly today because of last 3 year performance. We strongly feel this may not continue for long term. We can go to the next slide. This is again a key slide to understand. This slide tells you that equity, while traveling the path, is very volatile. What is volatile? In a year, the difference of high and low in equity can be as high as 40%. That is, if you have invested 100 rupees in the first year, it may go up to 140 or it may come down to 90 rupees. But volatility is not a risk, because equity on the long term is very, very predictable. I have put the figure there, 12 to 14% over a period of 15-20 years. So my predictability of performance of equity, when I mean equity, please understand I am referring to equity mutual funds only, not stocks. Nowhere I have mentioned that you should go and buy stock. Stock buying is not for people who are not experts. Stock buying is only for those people who are analyzing, watching, and breathing stocks day in, day out. A retail family, while having workload, while having to manage family, while having to manage office, has absolutely no bandwidth to go and choose stock, because buying one good stock is sometimes easy, but to stay in the stock, do the rebalancing, when to sell, when to buy again, how much to add next, how many stocks to buy to have the right kind of diversification, the retail definitely does not have that skill. As disciplined as you can be, one should not ever get into buying direct stocks on their own. The way to buy stock is basically going through an equity mutual fund, because equity mutual fund, there is a fund manager. Someone needs to be muted, I think.
Yeah. 1 minute. I'm not understanding one.
Can everybody please mute themselves? Millie Gupta.
I muted her. I muted her.
Okay,
I was
thanks.
not. I think I.
So, sorry. So what I was saying is equity mutual fund has a fund manager. A particular scheme typically has a main fund manager assisted by two assistant fund managers, one or two assistant fund managers. Between them, they manage a fund size anywhere between 500 crore to 1,000 crore, sometimes to the largest schemes available in the country is close to 50,000 crore and 1 lakh crore. These guys are the elite of this country. In my financial advisory, community in this country, the real top echelons are hired as fund managers. So you get intellect of the very best in the industry managing money for you, and you know how much you pay to appoint that fund manager to manage your money for a mutual fund. The cost is anywhere between 1% to 1.5% in a year. So in 1%, that is if you invest 1 lakh rupees, 1,000 rupees is deducted towards fund expenses, with which you get to get the advice from the very best in the industry for your money for years and decades to come. And the returns are spectacular, anywhere between 13, 14, and 15%, predictable. Direct equity, in the same breath, if I am talking about, if you do not have the right kind of stocks in a 5 stock basket or a 10 stock basket that you buy, two bad stocks can take your portfolio down totally. Your investment can get wiped off if you don't know which stock to buy, which one to retain, and which one to add. So while choosing one or two stocks from tips coming from friends or relatives or some experts, sometimes people come on TV and say, keeping those stocks for lifetime is not advisable without proper analysis technique to rebalance your portfolio from time to time. Direct equity portfolio requires rebalancing almost on a quarterly basis. Humanly not possible for professionals committed to their work to do this. Therefore, when I'm talking about equity here, I'm talking about equity mutual fund, and this is growing at 12 to 14% for last 15 to 20 years. Here, what is the risk is, if you are not in equity mutual fund, if you look at the other two graphs below, the inflation sometimes can be higher than the return that you make on assets which are not earning. Then there is a risk of exhausting your investments or savings in bank or keeping idle at home, and you may run the risk of financial imbalance at the age where you can't do anything to arrest it. So real estate, again, the problem of real estate is price finding. You do not know when you want to buy a flat. If you meet the same broker saying, I want to buy a particular flat, the broker will give you 100 rupees, let's say 100 rupees price. I go to the same broker and say, I own that same flat and I want to sell. he'll give me a price that I can only sell it at 80. The price difference for the same asset class is anywhere between 10 to 30% given the property, whether it is in Bombay or in Bangalore or in a small city. So when the price difference in real estate is so big, you don't know what is the exact value, number one. Number two, liquidity crisis. Real estate, you cannot exit in a hurry. Even if you decide to sell, it takes 3 to 6 months to exit a flat unless you do a fire sale. A fire sale results in 20-30% loss. In India, the third problem is the problem of quality of money, sometimes black, sometimes white. You have to manage that. Number four about real estate is the expenses. The recurring expense of real estate takes it out of the window because 3 to 4% of the value goes every year towards maintaining the property. People don't realize. So therefore, when price finding is not there, when there is no clarity on timing when you want the money to be, we do not advise real estate as an asset class to hold. We can go to the next slide. Please send your questions to Shaloni. I know I'm going through the slides without stopping. I will answer each and every question at the end of this presentation if you mark the questions to Shaloni. The power of compounding is what I wanted to define in this slide, that a 2% difference over a 10 to 15 years, 20 years can actually result in spectacular gains, and hence being in the right instrument for the longest term is advisable. This is the only advice on this slide. And FD, if you look at 6% doubles almost at around 12 years from the 72 formula, a mutual fund doubles at 4 to 5 years. We can go to the next slide. Same thing if you are investing through monthly contribution. What is a monthly contribution? In mutual fund language, it is called systematic investment plan or SIP. If you do not have lump sum and you're starting a career, starting your journey in the professional field, you have just got a campus placement, or you are getting into a new company and you have money to make, whatever earning you are doing, if you set aside part of it towards monthly investment, over a period of 5 to 10 years, you see the spectacular growth that you can get. Just before this session started, I was talking to the team which is organizing this WICCI event for me, that if a young lady starting her career does not take an EMI for 15 years, 15 years, and invests 15%, 50% of your salary in monthly investment in mutual fund, 15 years of investment, and you will not be required to work more than 20 years in your life towards financial independence. Let me rephrase it. Let's say you are starting your career at 25 and you have a 1 lakh rupees monthly salary. I am saying after tax, if you are making 1 lakh, or let's say 80,000, you give 40,000 every month towards monthly investment. 40,000 investment, if you start, and with your salary going up, if you keep increasing your monthly contribution, and you do this for 15 years, don't take loans. If you cannot buy a house, stay in a rented accommodation, cannot afford a car, wait for the money to build up from the remaining 50% to buy the car or a bike, stay in a rented accommodation. 15 years, you save monthly 50%. 20 years is all that you have to work. So by the time you are 45, if you have started your career at 25, and you have done the formula that I am saying, 50% of your investment, and you have not taken EMI, at 45, you are financially independent to live till 100 years. And I am saying, when I say you and your spouse and your children, all life cycle goals will be met for you in the social strata that you are in. And if you invest for another 5 years, let's say 20 years or 25 years, social strata will change and you will be one of the richest in the category that you are in. And still, you are financially independent till you live for 100 years. And you can leave money for your next generation. This is the power of compounding and monthly investment. We can go to the next slide. There was a question specifically on insurance before we started even discussing about this session. So I have put this only one slide, that the objective of insurance and investments are different. Insurance protects your today and investment builds your tomorrow. What is insurance? Insurance basically you buy as your financial replacement if in case anything happens to you. Insurance is never done towards investment that money will grow. Insurance is if you are not there, how much the family will receive. So my advice would be, if you look at the table below, buy a plain vanilla pure term insurance. Only if your age is between 25 and 40, 45. After 50, no point buying term. If you have a decent amount saved already, you don't need insurance above 60, and your investment will take care of your replacement value at the age of 55, 60 if you have saved through my formula of starting early and setting aside 40 to 50% of your money. That is my limited say on insurance. We can go to the next slide. Yeah, this is the slide where I will spend some time and explain to you the process of investment and onboarding. See, if someone contacts Das Capital, what do we typically do? We do a profiling of the client. We check about the family, we check about the cash flow that the person has, if there is any assets in the system already, and we try to onboard. What we look at is if the person has, let's say, a 45-year-old approaches us. He has 10 lakhs in the bank. He has a salary of 2 lakh rupees. We evaluate that. Small child at home. Sometimes, in this case, nowadays, most times I find the wife also is working. She has 5, 7 lakhs in the bank. And we try to plan the portfolio. What do? We tell them that keep the SOS or the backup money in the bank, maybe 2, 3 lakhs, remaining money to do a lump sum one-time corpus. Lump sum one-time corpus means from 10 lakhs from the husband will take 7, 8 lakhs, from 7, 8 lakhs from wife will take 5 lakhs. So that much will start as a lump sum investment. Then we check the monthly flow, how much it is. Let's say the husband is earning 2 lakhs, wife is earning 2 lakhs. Expenditure is mostly around 1.5 lakh in a month. So we have 2.5 lakh savings in a month. We try to start a monthly investment of around 2 lakhs. So therefore, we start the lump sum where we take the money into funds, and we start a systematic investment plan where we take the money monthly basis. And then we build the portfolio, announce a plan, put the goals in place for the child education, child marriage, any healthcare issues, future education plan by either of the stakeholders, husband or wife, holidays, all this we plan and create a 3-year, 5-year, and a 10-year plan. We roll it out. How do we roll it out? If the family, after seeing our plan, agrees with us, we tell them to share their PAN card. We check the KYC status, get the digital KYC done. If it is not done, if it is KYC is taken care of, then we complete the registration. Das Capital does entire investment digitally on the National Stock Exchange, NSE platform. NSE is one of the largest stock exchange in the world. We operate only on NSE platform. We do not take any money from any client in my firm's name or in my personal name. All investments, let's say Shiloni decides to open a portfolio with us. The account will be opened in Shiloni's name or with her choice, a joint account with Shiloni and her husband. Children will be the nominee. The account is opened using their bank, their PAN, with an NSE registration. We remain in this whole picture as the financial intermediary who is advising them. We are dispensable. Shiloni, after 5 years, for some reason, doesn't like us, need not inform us, can replace us with XYG, who she may have found after 5 years a better advisor than Das Capital. So we remain dispensable. We do not take investment into our name. We onboard digitally, and hence Das Capital is able to work with. Today, I have 400 families. We are scattered in close to 50 to 60 locations. America has close to 30% of my money. Rest of the world will have 5 to 8%. Bangalore, where my office is based, I have only 10% of the investments from Bangalore. My money is spread all over the country, various asset classes, various salaried classes. I have entrepreneurs, I have farm owners, I have professionals, and we are able to operate with all these clients seamlessly digitally. The reporting happens every month. We have an app where you can see your portfolio on a daily basis. You can do your execution yourself online. You can reach out to us when you have additional money. We do a rebalancing for every portfolio every quarter. We get back to you if there is a rebalancing needed. We give you a capital gains, if any, if there is a capital gains that has been realized in a particular year. Every year end we give that to give it to your CA for your tax filing. Therefore your taxation is seamless, investment is taken care of. When you need money within 1.5 days, 2 days, you get your money through a request. When you want to invest a new money, same day it can be invested on the digital platform, and we are dispensable throughout. So this is the system that we use to onboard a client, continue with a client, and forage to the future with financial growth. If you have questions on this part, please reach out to us at the end of this slide presentation. We can go to the next slide. If you have any questions, you can keep writing to Shaloni. I'll answer it after this slide. Yeah, we can go to questions, but before that, I want to, or after some questions, I'll play. I have a video which I've shared with Shaloni. I will request her to play after some time. Let's take some questions now, if you have questions.
Yeah, Mrunmay, some questions which have come before, and definitely Sakshi asking us, is buying land a good investment? Land.
Same.
So she's not talking about apartment, she's talking about land.
Yeah. See, again, land, the challenge of land is where it is situated. If it is in metro, it is very expensive. If you go to a small town, the quality of land, how clean is the, antecedent of the land, I have no clue. Again, the same problem of the property. If you go to small town, the black and white is a big issue. Number two, after you buy the land, how to protect and assert your ownership over the land throughout the period if it is far from you. If it is close to you and you are in a metro city, it is very expensive, unaffordable. Growth is minimal because getting a piece of land in Bangalore is unheard of. Therefore, you have to go to some suburb. And in suburb, if you buy, the growth is not the multi-bagger that it used to be between in the 90s and early 2000s. Today, the land growth is single digit, abysmal single digit. And the worst part in all this is, again, exit is very, very challenging. You cannot get out of an investment when you want money. In the investment of financial assets, the advantage is 48 hours you can get out of the money. You know exactly what you are worth when you are putting a redemption request to the last digit. No land in my career of 30 years I have seen has a finite or a value finding process where I'm happy or the buyer or seller both are happy. So therefore, I would not advise in today's day and age to buy land. Financial assets are the best to do.
Richa, you have a question?
Yes. Mr. Das, so I have a very practical question. Uh, let's say I'm a 40-year-old middle management employee kind of a person, and I have about 50,000 per month from my salary that I would like to invest regularly on a monthly basis. Now, how would you suggest I spread it across various asset classes?
So
So
that's
if I
a,
have 50,000 in a month,
yeah.
what are the different asset classes that I should be investing in? And roughly what proportion, what percentage in various options?
So before that, then I have a slide actually with Shiloni, which I did not want to show. But let us go to the last slide of my presentation, the asset allocation slide. This will, no, last. No, go down, go down, go down. Yeah. See, this is your answer, Richa. Slide looks very beautiful and, colorful and brilliant and weight and expected blended yield and everything. That tells you that I have a good young team who are very good at PowerPoints and Excels. This slide does not tell anything more than that. Now, the answer to your question, is it what it is showing in this slide? My answer is no. Why? I want you to invest the entire 50,000 in equity mutual fund. That is my answer. Let me validate my answer through logic. Why I am saying no real estate, no fixed income, no gold? Because Richa, you are saying a 40-year middle management. You already have certain amount of gold, which I don't know. Even if I ask you the question, I will not get the right exact answer of the gold that is sitting in your locker between you, your mother-in-law, or your sister. So gold is ruled out. Anyway, I would have given you 5% gold. So gold, because I have 400 families, I am telling you 98% of those families, I don't know how much gold they have. They've told me something. And some of them have insisted that I do asset allocation from the 50,000 you are giving. I have always told them asset allocation is on net worth, not on the money that you are committing to me. To calculate net worth, I need a lot of truth. How much inheritance you have? Does your father have a property? Husband side, how much you are getting? Which house you have purchased? How many flats you have? All these questions I have to answer to take the real estate out of the cube gone. One cube gone, gold gone. Now the real estate cube goes. Because I again don't have a clear answer from my client. I would like to have a client who comes to me saying, I don't own real estate, I don't own gold, and I have this much money. I can do an asset allocation. I am yet to meet that one client. 30 years and 400 families in Das Capital. In my career, I would have touched 2,000 families of 30 years. I am yet to meet that client who comes clean and tells me, Mrunmay, this is what I am worth. 50 lakhs in the bank, 4 lakhs salary. I have nothing else. This is it. So therefore, my team has given this slide. I deleted and put it at the bottom. I didn't want to share. But because you have this question, I thought at least let my boys get some credit that they've worked hard on. Because one of them or two of them, if they are part of this presentation, they'll hold me to it. That we gave it and he didn't show. So I showed it. I am through with them. About you, my answer is straight, simple. 50,000 is what you are giving from your monthly savings or surplus towards investment. You will keep earning money. Your salary will keep growing. Let me grow it at 15%, 14% or more for next 10 years. By the time you are 50, you have already saved how much? 50,000 per month is 6 lakhs per annum. 10 years, 60 lakhs you have given. If there is salary hike, this 50,000 at the end of 10 years, you would be giving me 1 lakh per month, not 50. Your salary would have gone up in 10 years. So imagine if you have contributed not 60, but with a progressive salary, let's say 75 lakhs into the portfolio, which is an engine of earning 15% over 10 to 15 years. Imagine how much money you are sitting on for 10 years of partnership with Das Capital. Just count the money. The first 50,000 in 10 years would be 2 lakhs, right? One double in 5 years, second double in 10 years. Now you do every 50,000, 10 years, 4 times. You are happily walking to the bank, telling my name and Das Capital to everybody you know, and I am getting so many new clients for someone like you. If I do just this, take 50,000 from you and put it in equity mutual fund and rebalance it like how I do, watch every quarter and rebalance it once, 2-3 years, we are sorted. And I'm sure with you, your husband or will join and people will put monthly money. And you know where the money goes from equity mutual fund? Very interesting conversation, little off this question. The money goes into nation building. How nation building? Equity mutual fund basically goes and buys stocks in the market. So what is stocks? Stocks are companies owned by promoters who have listed their companies in the exchanges. These companies, why they have come to you? Because they needed money. If you don't put 50,000, who is taking care of them? foreign institutional investor. India's best of the companies today are owned by foreign institutional investor, anywhere between 40 to 60%. So the biggest bank in the country basically is not an Indian bank anymore. It is owned by foreigners who own 60% of that bank. Why can't Richa own that bank with Siloni? And Richa Siloni joins and 5 lakh other people are there in your WICCI worldwide. And if they join, you guys are into nation building. I don't have to depend on a FII and his December holiday to sell the Indian stocks to get his bonuses. I don't have to. You guys don't have December, bonuses to sell the stocks. You guys are more stable. You understand India better. You will stay with this country. If you have bought a stock which is Hindustan Lever, you use their product. You will stay with the company. If you have bought a mutual fund which is owning Asian Paints, you know that paint comes to your wall. You will keep earning that, holding that mutual fund unit, and the country is blessed by your investment. So win-win strategy. You make 15% per annum. My promoters in this country have to borrow less from foreign investors. I hope I have answered this question very long
But if
one.
I would like to specifically understand, so equity mutual funds is with whatever my limited understanding is still a very vast area. What kind of mutual funds? Because there are large caps, there are mid,
Yeah,
small
see
caps, there are flexi caps. Like what is it?
that is again allocation in my team, which will do with typically for
But
50,000
but if
monthly.
I were to understand it, because I am, as an investor, I would like to understand how and where my money is getting allocated. So maybe I will also have 10 questions to do